Some trends are so influential they can move entire sectors of the market. Take demographics. Our aging population could impact the performance of all healthcare companies, but selecting precisely which companies will benefit can be challenging. The Healthcare Sector Spider ETF offers the diversification of the entire healthcare sector while minimizing your single stock exposure. The Healthcare Sector Spider, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for prospectus containing this information. Read it carefully.
You're listening to the Index Investing Show. This is America's only weekly program focused on the important stock and bond indexes and the financial products that track them.
And now presenting your host,
Ron DeLegge.
Coming up on today's program, the 3 reasons the Dow Industrials is a poor investment choice. We know it's often quoted, but we're going to dig down to why you should probably not own it inside your portfolio. Also coming up, we're going to talk about the market action, the volatility, and the pickup in that. Also, Elon Musk thinks index funds and short sellers are colluding. Oh, my goodness. A lot to get into on today's program. We'll also check the Twitter feed, 844-305-7800. That's the number if you'd like to join us. At Index Show is my Twitter handle. You can give us a call, give us your first name along with your city, and anything financial you want to talk about, we can do that. You can certainly give us your ticker symbols, any stocks, mutual funds, ETFs that you'd like to discuss. Again, 844-305-7800. So taking a look at market action this past week, S&P 500, a broad benchmark of U.S. stocks, large cap stocks, falling just over 4% on the week as key industry sectors like materials, industrials, financials, energy sector leading the decline. And it marks the S&P 500's third consecutive week of declines. But hey, look at your calendar, people. It's October. Would you expect anything less for such a bedeviled month in stock market history? October, well, it's not so good here in the U.S. It's great if you're in Germany. I mean, they've got Oktoberfest. Have some beer underneath the tent. Well, over here in the U.S., we don't quite do it that way. We basically chew our fingernails and sweat as equity investors. And we're seeing, like I said earlier, a pickup in volatility. You've got the VIX, which measures S&P 500 volatility, up on the year by 93%. Now, mind you, the VIX was up about 10% up until this recent spout of volatility, so it was pretty quiet. Pretty quiet for most of the year. We had a huge pop in February, but after that, it's been calm waters. And now we're seeing, once again, a pickup in volatility. Now, something else I'd like to point out to you also is the Fear and Greed Index, a pretty neat indicator devised by CNN. And it tries to explain, are investors greedy or are they fearful? And for us, that basically tells us, well, if people are greedy, that means we need to be more cautious. We need to start taking some risk off the table. Conversely, when people are fearful, well, that's a good time to be greedy. And so right now, the Fear and Greed Index, as measured by CNN, is at extreme fear levels. They've got this barometer of 0 to 100, with 100 being the most greedy and 0 being extreme fear. Right now, we're at 11. We're at 11, and if you go back 1 year ago, we were at 77. Heck, if we go back 1 month ago, we were at 59. Now we're at 11. In other words, the fear level is very high right now. And so investors are fearful, and I think that's good. Markets have been mostly up. And if we look at the total U.S. stock market since the start of the year, ticker symbol SCHB is the Schwab ETF that tracks total U.S. stock market, ahead by 4.3%. We were up as much as 10 or 11%. And the point is that markets have to breathe. In other words, you have to inhale and you have to exhale. You can't just inhale, inhale, inhale. It's not healthy. And so it's the same with financial markets. We can't just go up. We cannot have one directional markets that just move up, up, up all the time. It's simply not healthy. So what we're seeing right now is absolutely normal. The markets are breathing, and this is the way it should be, not just a one-directional market. 844-305-7800 is the number if you'd like to join us. How did your investment portfolio do this past week? How are you holding up with all of this volatility? Have you built a permanent and adequate margin of safety? See, if you haven't done that, that's your homework assignment, because the folksy advice to do nothing is only true if your retirement portfolio has a adequate cushion or margin of safety that's permanent, and then your asset mix is correctly aligned with your age, your time horizon, and your unique psychotic makeup. And each of us has a unique psychotic makeup. You are a different type of psycho than I am. We all have a different psychotic makeup. And so this is what the investment portfolio, the retirement portfolios we put together should reflect. It should accurately reflect who we are. It should match our personalities as investors. It should match our risk profile, our age. And again, the folksy advice that, well, don't do anything. That's only true if you've done these things. 1 and 2. Like I said, if you're investing without an adequate margin of safety, this folksy advice to do nothing does not apply. And from what I've seen, most investors, most retirees do not have an adequate margin of safety. If you've got your portfolio in all stocks and bonds and that's all you own, you do not have an adequate margin of safety. I'm sorry. And so now is the time to look at your portfolio before the real correction, before the real meltdown comes. Because this is nothing. This is absolutely nothing. In fact, on our Twitter feed, it was funny. I did a retweet. This is from Kate's dad, at KAS Dad is the user. And he had this to say: for every idiot out there using the word crash, please stop. You do not know pain. The S&P 500 was down 3.25% in one day this past week. But if you go all the way back to October 19th, 1987, S&P 500 was down over 20% on one day. Do the math yourself. This is not a crash. I've got that on my Twitter feed at Index Show. Absolutely true. We need perspective. This is a flesh wound. This is a modest pullback. It's not a crash. Taking a look at some other key areas, if we take a look at global stocks, starting with international developed markets, VEA down almost 8%. Emerging markets still struggling. VWO down almost 14%. Total U.S. bond market down 2.3%. Speaking of bonds, mortgage rates here in the U.S. have jumped to 7-year high. 30-year fixed mortgage loans now just under 5%. Will we get just above that? Going to be interesting to see what happens with that. We see already signs that the real estate market, housing market in particular, is slowing down. Total U.S. Global REITs, known as Real Estate Investment Trust, down about almost 4%, REET. And we're going to take a look at some key industry sectors coming up in a little bit. We'll take a look at technology, financials, healthcare. We'll tell you what areas are leading, how they've been performing. And also want to take a look at some of those inverse performing ETFs that are designed to go up in value when stock prices fall. And man, we've seen some life there in some of those particular exchange-traded funds. So I'm going to tell you all about that. Coming up, our headliner, we're going to talk about 3 reasons the Dow Jones Industrials is a poor investment choice. DIA is one of the ETFs tracking the Dow, and we're going to explain to you how the Dow is, how it started, how it's composed, and how it's calculated, and some of the flaws with the Dow compared to modern era indexes. So stay tuned for that. If you'd like to join us, we're here, 844-305-7800. At Index Shows, my Twitter handle. More when I return.
The Index Investing Show with Ron DeLegio.
Have an investing question for Ron? Call 844-305-7800 or send your questions to @IndexShow on Twitter.
All right, welcome back from the break, 844-305-7800. This is the Index Investing Show. We're here if you'd like to talk about any particular stocks, mutual funds, ETFs, or how your retirement portfolio is doing with this pickup in volatility. As I told you earlier, we now got the S&P 500 Volatility Index up almost 100% on the year, and we saw a major jump this past week, a jump of about 85%. So volatility is back, and, you know, it never really leaves. It's a constant. It's one of those things that mimics nature when you think about it. I mean, the Earth is on an axis. I don't know how fast it's circulating. Is there any astrophysicist listening to the program? I'm sure you would know that. How fast the Earth is turning. But my point is that everything in nature has movement. The ocean has movement. The air has movement. The universe has movement. And so that's what the market is reflecting. It's basically a reflection of nature. And in many instances, it's really a reflection, when you think about it, of human nature, because market prices are shaped by the psychology of the masses. The investing public. If the investing public is depressed, well, that'll be reflected in market prices. Conversely, if they're elated, what happens? You have a market that is reaching all-time highs, and it has a lot of fluff in it. So these are the things you need to be aware of. Psychology is a very important factor in determining market prices, probably the number one factor. Market is not moved or motivated by PE ratios and dividend yields and indicators. None of those things really matter at the end of the day. It's really the psychology of people that determines prices. So these are things that you need to keep in mind, and it's important too that we understand ourselves and that we not do anything that would upset our long-term retirement plan, and that we make sure that we stay on target, and that we're rooted, and that we have an adequate margin of safety inside our investment portfolios, because there's no way that you can handle an even bigger rise in volatility down the road that will come if you're fully invested, right? Fully invested portfolios, we don't believe in that here on the Index Investing Show. No one should be fully invested. That's a silly, silly idea, fully invested. That's something we'll maybe talk about on another show, but the context for an architecturally sound investment portfolio, there's three buckets. You have the core of your portfolio, which can be fully invested in a broad array of major assets like stocks, real estate, bonds, commodities. Those are the major asset classes. So you begin there. And then your margin of safety is, you might say, uninvested. It's earmarked for safety. It's 100% free from volatility, free from market risk, and it secures and guarantees income. So that's your margin of safety that complements your core portfolio. And then your non-core portfolio can be fully invested, but it's tactical in nature. You invest in minor asset classes or sub-asset classes, areas that are maybe more risky, more concentrated. You can invest in cryptocurrencies, individual commodities like gold. You can invest in volatility-linked funds or ETFs. You can invest in leveraged funds, inverse performing funds, individual stocks. See, that's the context for your non-core portfolio. So when you put these three together, the core, the non-core, and then your margin of safety, now you've got something. Now you've got a a portfolio that can help you reach your goals in any type of market climate, not just a good climate, because markets aren't always good, right? And we want to be able to perform. We want to be able to deliver results even when conditions are not friendly. And so this is the whole point of the framework that I've just explained to you for building and managing a retirement portfolio. Now, taking a look at some of the key market indexes linked to sectors and the ETFs tracking them. So one of the big ones, the biggest ones inside the S&P 500 is the technology sector. Technology as a group has performed very well. Technology stocks within the S&P 500 represent about 20% of the overall sector exposure of S&P 500. Now, XLK is the ETF that tracks the technology sector in the S&P 500. It's got 66 holdings, and some of those stocks have gone down dramatically this past week. But take a look at the entire group. Technology XLK ahead by almost 12% on the year, even with this drop. And so that's very, very telling of how good technology has been. Now, another great performing sector has been healthcare. Ticker symbol XLV, which has been another great performer. XLV ahead by 11.3%. So those two sectors still in double digits. And I want to tell you, going back to the technology sector, a company in the technology field that had a recent change in its product lineup, Google. GOOG, I guess the parent company is now known as Alphabet. It's been that way for a while. But anyway, Google Plus has been killed. It's that social network that Google developed and never really got any kind of following. So Google Plus is history, and that was a big change for that particular company. Also, another company in the news, Netflix, NFLX, got hammered this past week, dropping about 8.4% on the week. And Netflix has been a weak performer for the past week. But, of course, we've got to have context, right? We've got to look at the bigger picture. Netflix has been a great performer over the past several years. It continues to innovate and be a company that many consumers are using. So that company in the news. Also, Sears Holdings. Sears, ticker symbol SHLD, is expected to file bankruptcy. A very sad story. Here's a great company. I'm from Chicago. This company, when I grew up, was everywhere. And it was much like what Amazon.com is today and what Walmart is today. It was a leader. It was an innovator, but they lost their touch, and now it's a company that's about to go bankrupt. And so that particular company has been a horrible performer. We also have something on our Twitter feed at Index Show all about this. There's a fund manager who at one time had a very hot hand. His name is Bruce Berkowitz, and he was banking on this particular company, Sears, making a strong comeback. I have a retweet from that. I took a picture of the Wall Street Journal. This was back in July of 2017, and they had a cover story all about Bruce Berkowitz, the fund manager who's staking his comeback by investing in Sears. And at that time I said, in a very sarcastic way with a question, so Bruce Berkowitz is banking his comeback on Sears? Is he a glutton for pain or what? And so I retweeted that, and it's something to think about as Sears prepares for bankruptcy. It's pretty amazing, the fund managers that got this one wrong. And it just is a very, very strong lesson to help us understand that today's hotshots are tomorrow's turkeys. So whoever's hot today, pick your favorite fund manager, pick your favorite venture capitalist, pick your favorite stock picker. They're hot today. Well, guess what? the laws of inertia, the laws of gravity, means that they're going to be tomorrow's turkeys. And that's why that type of investing only belongs in your non-core portfolio. So when we come back, we're going to talk about the Dow Jones Industrial Average. Don't use it inside your portfolio.
The Index Investing Show with Ron DeLegge.
The investment world is full of complex and expensive products. At Sector Spiders, we recognize the need for lower costs, more clarity, and greater focus. So we wrote a new chapter for today's investors. Sector Spider ETFs divide the S&P 500 into 10 distinct sectors. You can see exactly what you're investing in with full transparency. Each sector has the diversification of a mutual fund, the flexibility to tailor your investment strategy, the all-day tradability of a stock, and the tracking of an index. Sector Spider ETFs can be used to customize your portfolio allocations, overweight or underweight your sector exposure, and minimize single stock risk. Now it's time to turn the page to a clearer, more focused approach. Sector Spider ETFs, the next chapter in investing. Before investing, consider the fund's investment objectives, risks, charges, and expenses. Go to sectorspiders.com for a prospectus containing this information. Read it carefully. Visit us at sectorspiders.com.
Stop investing blindly. Listen to the Index Investing Show with Ron DeLegge every week on iTunes and IndexShow.com. Learn how to grow and protect your money.
Okay, we got some other things on the Twitter feed that I'd like to share with you. Here's another company that was in the news, Starbucks. Starbucks, part of the Consumer Discretionary Group, ticker symbol XLY. This particular company was added a stake. William Ackman, an activist hedge fund manager, disclosed a 1.1 stake in Starbucks, 1.1% stake in Starbucks. So that was a recent addition, and that particular company, as I said, XLY is the ticker symbol. That particular sector has been a pretty good performer. XLY ahead almost 11% on the year. And the other thing I wanted to mention, consumer discretionary, some of those other stocks inside that that particular ETF, XLY, you got Amazon.com, Home Depot, McDonald's, as I mentioned, Starbucks, Nike. So that's obviously, companies tied to retail, automobiles, consumer durables, hotels, restaurants. That's XLY, and that's been a very good performing industry sector within the S&P 500. So that's what's going on with that particular sector. That one's been a good performer. Now, some of the, we told you earlier, some of the rate-sensitive industry sectors like utilities and real estate have struggled this year. We've got S&P 500 real estate stocks, also known as REITs, XLRE, down about 3.5% on the year. And that is definitely underperforming the broader S&P 500. But then you've got utilities, which are ahead by just over 3% and actually have been helped by defensive buying. So as investors have shifted to more defensive stocks, I think that's helped with utilities. And XLY, or XLU, is the ticker symbol that tracks that particular sector. Also, in other news, anybody out there receiving a Social Security check? Well, you're going to get a pay raise come 2019. That's because in 2019, there's going to be a cost of living increase of 2.8% for Social Security. That's going to translate into an average increase of $40 a month for the average retiree. Now, this cost of living adjustment is based on a formula that reflects changes in consumer prices. It's going to be the largest for the monthly payment increase since going all the way back to 2012. So this year, the increase, again, or in 2019, the increase is going to be almost 3%. So that's a good thing for those of you receiving Social Security. You're going to get a pay increase. And certainly with healthcare costs rising it's a much needed increase. So let's talk now about the Dow Industrials and why they are a poor investment choice. I'm going to try to focus on a couple of reasons that you need to know about of why the Dow is a poor choice. Now, of course, on any given day, the media is going to report what the stock market's performance is in the U.S. by citing the Dow Jones Industrial Average. And although the Dow is still the most widely quoted benchmark of U.S. stocks, along with the S&P 500 and the NASDAQ, it falls short as an investment vehicle. And I want to explain 3 reasons why. The first is that it uses an outdated calculation method. Now, back in May of 1896, Charles Dow originally composed the Dow Industrials with a portfolio of just 12 stocks. Since then, the Dow has experienced stock holding changes 52 times, and none of the original 12 companies remain part of the group. Today, the Dow has expanded its club to 30 stocks. But despite the vast improvements in the indexation of stocks since the Dow's formation in the late 1800s, the Dow's calculation has remained unchanged. See, unlike today's era of modern conventional stock market indexes, the Dow uses what's called a price-weighted calculation method. So what does that mean? So basically, Dow companies or stocks with the highest stock price have a greater influence on the Dow's behavior and performance compared to the lower price stocks. Most investors agree that the stock market capitalization is more accurate representation of a true equity yardstick versus what the Dow is doing. It uses simply the stocks with the highest price that have the most influence on the underlying benchmark. So as a side point, I'd also like to just say that the name Dow Jones Industrial Average in itself is highly misleading. The original components were mostly industrial stocks like railroads, but today the vast majority of the Dow's modern era roster is from non-industrial stocks. In fact, just 5 companies within the Dow, Boeing, 3M, Caterpillar, Dow DuPont, and United Technologies, can accurately be called industrials. The rest are committed to other industry sectors. So that's the first reason. It uses an outdated calculation method. The next reason is, as you might have guessed, it's an under-diversified yardstick. Can a 30 stock portfolio like the Dow truthfully represent the total U.S. stock market? Well, the answer is a resounding no. So the Dow lacks exposure, when you look at it, to important areas of the stock market where future growth is likely to be the highest. We're talking about areas like mid-cap and small-cap stocks. These are companies with a market size between $250 million on the small end, all the way up to about $10 billion on the big higher end. Because the Dow only contains exposure to a handful of large company stocks, it badly misses on diversification. The other thing, too, is the top 5 holdings contained within the Dow currently represent almost 35% of its total weighting. That's way too much, especially if you're a yardstick purporting to be a broad measure of U.S. stocks. By comparison, the top 5 holdings in the S&P 500 represent not even 15% of the index's total weighting. So clearly, the Dow falls short. It's an under-diversified yardstick. And finally, show me the sectors. It lacks, when you take a look at the Dow Industrials, it lacks a deep and expansive industry sector exposure, and that's another major flaw. The Dow owns stocks tied to 9 different sectors like energy, financials, and technology, but just 5 or less stocks represent each industry group. It's just not possible to accurately represent entire industry sectors with a handful of stocks. And so, for that reason, the Dow comes up short yet again because of its shallow exposure on the sector side. And so what is the conclusion? What is the summary here? Why is the Dow Industrials such a poor choice from an investment perspective? Well, we already explained to you those reasons. It uses an outdated calculation method. It's an under-diversified yardstick. It lacks broad and deep industry sector exposure. And so, in the end, investors are much better looking to other ETFs that offer wider exposure to the total U.S. market, something like, for example, the Schwab Total U.S. Stock Market ETF, ticker symbol SCHB, or the iShares Russell 3000, ticker symbol IWV. These are better portfolio building blocks if you want exposure to U.S. stocks versus holding a narrow portfolio of widely held stocks like the Dow. So that does it for that explanation of why the Dow is a poor choice from an investment perspective. Coming up next, we're going to talk about Elon Musk. He thinks index funds and short sellers are colluding. I'll be right back.
The Index Investing Show with Ron DeLegge.
You're listening to the Index Investing Show with Ron DeLegge. Go to indexshow.com to enroll in Ron's online classes for investors. Learn how to grow and protect your money.
Okay, just by way of reminder for our regular radio listeners, if you ever miss the regular broadcast, which happens every Sunday on radio, you can pick up our podcast. It's available at our website, indexshow.com. You can also find our podcast on our YouTube channel. It's available, just search under the Index Investing Show. You can also find us on Apple, iTunes, as well as Google Play and SoundCloud. We're there. So we're pretty much everywhere. You can also listen on our Twitter feed at Index Show. If you can't find us, it's your own fault, because we're pretty much everywhere. So I want to talk to you now real quick here about Elon Musk, one of the co-founders at Tesla, claiming that index funds and short sellers are colluding. So he did this in early October. He sent a series of angry tweets blaming the securities lending done by index funds and ETFs with having no rational basis. He claimed that it gives short sellers strong incentive to attack publicly traded companies. Moreover, he inaccurately stated that passive indexing accounts for most of the stock market investing that is done today. So in SpaceX terms, Elon has airlifted into another solar system. So first, let me just say that indexing is big, but it's not that big. It's gone mainstream, but it still does not constitute the vast majority of the market. And if we look at index funds as a share of the total U.S. market, it's still very small. The Institute, or the Investment Company Institute, ICI, tracks this. And they show that index fund share is still very small. When I say small, it's under 20% of the total market. It may take several years more before assets held in index funds surpass actively managed funds, but indexing is still in the minority, Elon. Now, where he is correct is that most investors probably don't realize that the index funds or ETFs that they own, some of them do engage in what's called share lending. Now, as evil as that may be to Elon, it's not illegal, nor is it nefarious. In fact, reputable fund companies often return all or most of the revenue that they generate from securities lending. And that's the reason why they even engage in that. Funds can garner extra income by lending securities to outsiders who often happen to be short sellers. And of course, the short sellers, what are they trying to do? They're trying to make money when the value of those securities that they've borrowed decrease in value. And then they hopefully lock in gains. More often than not, though, short selling is an unprofitable exercise for everyone but the securities lender. So although securities lending is widespread today, the SEC does place limits by mandating that the total value of borrowed securities may not surpass 1/3 of the fund's total market value. Many funds and ETFs stay well below that lending threshold, and in the ETF market, any revenue gained from securities lending is frequently very small, even for funds that lend out hundreds of millions of dollars in securities from their portfolios. So that's the lowdown on securities lending. But in response to Elon's criticism, accusing index funds and ETFs for aiding and abetting short sellers of stock is a stretch. Share lending is incidental. It's not primary. It's incidental to the index fund and ETF business, and it's not illegal. Moreover, short selling allows speculators to express their views about a stock. It's a free country. They can do that. There's nothing wrong with that. In fact, the negative views, the increase in scrutiny, it helps with transparency of corporate practices and corporate behavior. That can be beneficial to investors. As much as Elon doesn't like that, nothing wrong with it. There's nothing illegal or nefarious about it. In fact, I think it's a good thing. Shining a little bit of light, a little bit of sunlight can certainly give us an indicator or indication of what's going on at these companies. So targeting index funds as co-conspirators with short sellers, I think, is a reflection of just how far Elon's paranoias have traveled. And right now he's in desperation land, if such a place even exists. If he was as compulsively obsessed with delivering cars as he is with short sellers, I think production hiccups at Tesla would. So going forward, Elon, ignore those short sellers. Isn't your genius best spent on building a world-class company with innovative products that win over the long term? That's what you should be focused on. And in the long run, I think that's what matters. And so in the meantime, that's the lowdown on index funds and short sellers. No, they're not colluding. They happen to do business with each other. It's incidental, and it's quite common. 844-305-7800 is the number. This is the Index Investing Show. I wanted to answer a question I got through email from David. He says, "Hi, Ron. I generally use 7% trailing stops. What is your recommendation?" So 7% trailing stops refers to basically an automatic sale that's triggered if your investment, whether that's an ETF or stock, falls 7% or more, you're automatically out. And a trailing stop simply means as that the share price increases, well, that 7% stop loss is going to trail. It's going to edge higher as that stock price or ETF increases in value. So that's a very smart strategy. And my answer is I think it's okay to use a 7% trailing stop, but for more volatile stocks or more volatile ETFs, David, you may want to increase that. You may want to go from 7% maybe to 10% or 12% or 15%, especially if you're using some of those leveraged ETFs with 200% or 300% daily leverage. I mean, those types of funds swing easily anywhere from 3 to 5% or more on a single day. So if you got a 7% trailing stop, you're going to get kicked out of that trade very quickly. And you may not want to get kicked out. So you have to have maybe a bigger leash or longer leash for some of those more volatile funds. And but I think 7% in general for unleveraged ETFs is a good rule of thumb and a good idea for protecting your downside. So thank you for that email, David. If you'd like to send me a question or comment, you can do that on Twitter at Index Show. You can also email me directly, ron@indexshow.com. If you'd like to learn more about where these type of funds go inside your portfolio, we talk about the core, the non-core, your other portion of the portfolio called the margin of safety. Go to indexshow.com and click on my online classes, and there you can enroll. Now, taking a look at some of those leveraged funds, bulls and bears have both been making money. And we see that if you take a look at the bulls, some really good performance. TECL, which aims for triple daily leverage to technology, ahead by almost 23% since the beginning of the year. That's been a great trade. Healthcare, 3X ETF from Direction, CURE, also up almost 25%. So that's been a great trade, those two ETFs, sector-wise. If you've been leveraging them, that's been the right place to be doing that. Now, what about bears? It's commonly thought, well, bears have been losing money. Well, if you've been a selective bear and you've been shorting, for example, emerging markets and long-term U.S. Treasuries, you've been making some money. EDZ, which aims for triple daily opposite performance to emerging markets, has jumped over 35% since the start of the year. TMV, which aims for triple daily opposite performance to long-term U.S. Treasuries, that one's been a great performer, ahead by almost 27%. So those two ETFs for you bears, you want to be selective, right? If you're going to short the market, you can't just do it randomly. You got to pick those weak spots. And long-term U.S. Treasuries have been weak. Emerging markets have been weak. And so that's where you focus your trading energy and your resources on. Well, that does it for another episode of the Index Investing Show. Be sure to join us again next week. We'll be here. Same time, same station. @Index Show is my Twitter handle. Follow us 24/7. Until we meet again, may the market indexes be with you.
The opinions expressed in this broadcast are not necessarily that of our advertisers, sponsors, or broadcast partners. The discussion of investing is general and should not be construed as investment advice or an offer to buy or sell securities. Listeners are responsible for their own investment decisions and results. Before investing in mutual funds or ETFs, always consult a prospectus for risk, charges, expenses, and other information. Read the prospectus carefully before investing. Past performance is not indicative of future results. No reproduction or dissemination of the Index Investing Show is permitted without the expressed written consent of its producers.